Hello and welcome to Livewire Markets. My name is Chris Conway. On today's Views from the Top, I am sitting down with Elston Asset Management Executive Director and Portfolio Manager Bruce Williams. Bruce, thanks for sitting down with Livewire today.
Pleasure, Chris. Thank you.
Before we dive into how you're seeing markets, can you just share with the audience a little bit about your investment background and how that dovetails into the Elston investment philosophy?
Sure, Chris. I've been at Elston for over 20 years now. We started it right in the middle of the GFC. We come unusually from an IMA background, and we've moved up into SMAs and then unit trusts after that. And probably that direct exposure to the end investor has really shaped not only our process but our philosophy as well. In terms of direct portfolios, the end client can see everything. So it's how we manage the portfolio on the day-to-day basis. We think about the risk that our portfolios generate for them, such as key person risk. So we manage as a team of portfolio managers. We think that gets rid of self-biases. Everyone has a bias and everyone has a way of looking at things, and it lays off that type of risk all the way through to communications. So explaining how you're positioned and why you're positioned that way.
Bruce, the focus of the conversation today is on Elston multi-asset strategies. They combine funds and equities across a global landscape. How are you and the team seeing the market conditions right now? What are the two or three big themes that you're wrestling with?
Well, firstly, we think the underlying drivers for the economies are quite good. If you think about low unemployment rates, if you think about wage growth coming through, which is usually quite a good thing. On the flip side of that, you've got higher interest rates. Our base scenario is that interest rates will be higher than expected for probably longer than expected. That obviously affects the way you value assets, and it doesn't matter whether it's fixed income or equities or even property or infrastructure. The underlying risk-free rate is the basis of all valuations. So we're a little concerned about those valuations, and it's not across the board, but there are certain parts of the market that we think are quite frothy. The other component is that we think rolling forward to this year, profit growth will be a little more difficult. If you think about cost of doing business has been rising and is staying high. We think revenue growth will be a little more difficult because demand is becoming patchy, and we think that's not really reflected in the current share prices.
Bruce, just to follow up, how do we marry those, concerns that you just outlined with the fact that the Aussie market's trading near all-time highs? It's sort of 2 + 2 doesn't equal 4 at the moment.
Yeah, well, that's the interesting thing. At the end of last year, the market took off on the expectation that we're going to see a whole raft of rate cuts. Yeah. And those expectations have been wound back, yet the valuation of the market hasn't really changed. And we have been talking about this. Quite often you'll see the market looking through peak rates to the other side. But again, if we think the cycle's going to be more elongated, well, then that doesn't really make sense to us. Also, it's the narrowness of the valuation. So if you think about positive returns over the last 12 months, it has been very, very narrow. And so we're still finding plenty of value in those areas that are probably perceived to be less popular. You can take on risk in the operating environment for a business and how that business is positioned within that environment, or you're taking on risk through the price that you pay for an asset. And so I think risk management at the moment is really important.
Bruce, given all those beliefs and that groundwork that you just laid for how you're seeing things, where are you seing opportunities right now? They always exist, even when things are tough. So where are you spending your risk budget at the moment?
Well, we're not spending all our risk budget, Chris. We're slightly underweight growth assets and overweight defensive assets. We think fixed income is about where it should be. We're gradually adding duration to that part of the portfolio. Historically, when inflation really took off, we were very underweight duration, and we're now adding that in. We're probably also seeing opportunity within growth assets or within equities. We're seeing in the more defensive end of the market. Obviously, you've got some very good businesses out there, more technology related and the like, but again, the opportunity versus the price gives you pause for thought.
Can I just press you for some of those defensive equities, Bruce? Can I get a couple of names maybe? I just know the audience will be keen to hear some names.
Sure. Well, if I give you a couple,
yep.
The first one is ResMed.
Yep.
So that's healthcare. And ResMed is topical at the moment. You know, GLP-1 drugs, losing weight, don't need a CPAP machine anymore. We don't think that's the case. We think demand, it's a very underpenetrated market. We think demand will be there for a long time. And it's one we've watched for a very long time and wanted to own prior to the GLP-1 drug issue that they've had, but it never stood up on a valuation basis for us. And this is, with a lot of research, and it gives us now opportunity. It's got demographics in its favour. Unfortunately, we're all getting older and fatter, other than GLP-1 drug users. It's healthcare tends to be reasonably defensive. They've had elevated costs as a result of COVID that we think will roll off. So there's plenty of opportunity there. A second one, which is a completely different type of business, and it's more how we're thinking about, say, the Australian equities at the moment and how we want to be positioned within that sleeve, is the Lottery Corporation. Yep. So obviously that's your Gold Lotto business. It is very, very stable. It's got a digitisation on its side. So if you think about Gold Lotto tickets, you used to have to go into the newsagent to buy one. Now they email you and say there's a prize of $40 million tomorrow night, buy a ticket, and that is generating greater demand. They've also got product development, which is leading to better pricing, so that's a pricing lever for them. And also it was a bit of an opportunistic buy last year. Their jackpot cycle was out of whack with long-term averages, and so that gave us an opportunity to buy in when jackpot cycle was abnormally low.
Bruce, thanks for those picks. I'll just dial it back up a little bit to a higher level. We went to the stock level there. Biggest risks at the moment? What are you guys wrestling with in the war room at Elston? What's the biggest thing that's maybe robbing you of some sleep, perhaps even?
There's a few things. Where do you start? We often get asked when presenting around geopolitical type of risks, and that's something you've sort of got to be aware of, but you can't really factor into portfolios. So that's by the by, I suppose. We're a cycle that's higher for longer. We don't think is being priced at the moment. We think there'll be disappointment if it is higher for longer, and that should be reflected in asset prices. I can't help but get on my politics bandwagon. I think what we're seeing not only domestically, but I'll use domestically as an example, is politics over policy. And I think that's a real risk, because often it's not to the long-term benefit of either the Australian people or the Australian economy. And it also creates these enormous skews within the market. So we're seeing probably more intervention into markets than what we've seen in a long, long time. And again, businesses require a reasonably stable framework in which to invest, and they won't do it. They won't do it if they don't know what the framework is. They don't know what the rules are. So I think, we're seeing a grocery inquiry at the moment, obviously gambling. We've seen even NDIS is having an impact on healthcare businesses, and obviously energy markets last year was another big one.
A lot of uncertainty out there, isn't
there? Absolutely, and if you think about it from a CEO perspective, they're not going to have a massive CapEx program on a market where they know the government's feeling around. It's just not in their interest to do it.
Bruce, for investors who might not be familiar, and just so we're having this conversation through the right lens, can you tell us a little bit more about the multi-asset strategy? What is it designed to do, and what problem are you trying to solve for investors?
Sure. The multi-asset strategy, well, there are multiple portfolios based on differing amounts of growth and defensive assets. And that goes back to risk return requirements of the end investor, so people select which blend they want. In terms of what need it fulfills, the majority of the people that use this are financial advisors, and it's really a whole of portfolio solution for them. So it basically is a very easy solution for them. We think that often they like spending more time with their clients. And our portfolio is very easy to use. It also reflects that if you think each of their clients are individual investors, we tick quite a lot of boxes around. We're certainly not hyper aggressive, so what we're aiming for is consistent long-term returns. Every security or fund within the portfolio has daily liquidity, so if their end customers have a requirement, we can free that up for them very quickly. So it's a very easy solution to use.
Bruce, you've touched on some of the core positions. You talked about adding duration, a couple of the stocks. What are some of the other core positions that you hold, and why in those multi-asset portfolios?
Sure. Well, yeah, I've already talked about duration with the fixed income, which we're overweight at the moment. Within Australian equities, it's very much healthcare is probably the standout there. So I've talked about ResMed previously, but we do have quite a few other holdings. Again, defensive characteristics, demographics in its favour, strong market positions, and several ways in which they can grow value over the longer term. They do have short-term headwinds, usually in the way of costs, particularly labour, but we think they'll dissipate over time. In terms of international equities, and this is probably more interested, I suppose, is that we're seeing absolutely huge dispersions at the moment. So if you think about the US versus everyone, in terms of how the markets are travelling, you think about mega cap versus small cap, you think about value versus growth, massive dispersions. And so we're just threading our way through that with core positions and then satellites to managers we think can add value in the current environment.
So the satellites are where you try and get a little bit more return for maybe a little bit more risk? Is that sort of how it works?
What we try and work out is the exposure we want, and we'll use either passive or active to get that. So, for example, we have a SP 500 ETF in there, but then say AB is our core international style neutral manager, about market beta, so nothing ridiculous there. Then we have, for example, GQG as a satellite, because they tend to shift their exposure very, very rapidly depending on where they see values. So it's the satellites can move around a fair bit, but the core exposure hopefully will add a little bit of alpha over time, but it's not designed to be a really volatile ride for the end investor.
Bruce, we've talked stocks, so I'll get you to pull out the crystal ball now. What is one risk you think the market is underestimating, and what do you think will provide the biggest opportunity for investors over the next 12 months? So we'll do the risk the market is underestimating first.
I think it's probably interest rates and the impact of interest rates. And the reason why I say that is the central bank, through monetary policy, is trying to do a job to bring inflation down. But at the same time, you have both state and federal governments taking fiscally expansive positions against them. And so even today, CPI came out above expectations. And again, I think rate rise expectations have gone, I was just reading before I came in, something like 14% to 50% over the next 3 months, I think it was. So if it is higher for longer, there is a lot of stress within the Australian consumer, and we're just starting to probably see that crack now. So again, you know, property prices are very expensive. Well, everything's very expensive, and again, businesses, something like 60% of GDP is usually consumer, or consumption, I should say, not consumers. So again, if you see cracks there, costs are only going one way. You know, it'll lead to a probably more elongated high interest rate cycle, which I don't think anyone will particularly enjoy.
Right. Now the other side, the biggest opportunity over the next 12 months. What's the other side of the coin?
I think opportunity is maybe in the unpopular. You know, anything that's perceived to have low risk is really priced very handsomely at the moment, and probably the risk you're taking on by doing that is by the price that you're paying. With those that are a little unpopular, it takes more work, and you've got to be confident in what it is you're doing in terms of the research that you're doing. You've got to be confident in that you've got the thesis right. And then, you know, we have quite a long-term investment perspective, and then it's a function of keeping an eye on it but letting it play out. So I would think there's still plenty of value out there, but you do receive calls going, why have you bought this asset? Are you crazy?
Bruce, just a follow-up question there. What's more important at the moment? Is it asset allocation, or is it the assets that end up within those allocations?
I think it's both. So if I think about how we're positioned, we're slightly underweight growth assets, but even within those growth assets, we're probably more defensive.
Yeah, right.
So if you talked before about risk budget, we're probably doubling down a little bit on the risk budget through being more risk adverse at the asset allocation perspective, and then a little bit more conservative within, say, the Australian equity sleeve, for example. I might just point out that our portfolio is a little unusual. If we talking about, say, a balanced growth allocation, we do, versus our peers, have a higher allocation to Australian equities versus international. Yep. And the reason for that is franking credits are very important to Australian investors, particularly with the majority of investment out there being the likes of superannuation. And also Australia tends to run a higher dividend yield than other markets. And if you're a superannuant, you want cash flow from your investments to match your pension payments, and so it alleviates that cash flow mismatch problem.
Right. Bruce, last one for today, view from the top. That's the segment that we're participating in today. What is the one thing that you've learned from your years of experience and investing history that you wouldn't have if not for your journey?
I'd probably say you've got to be prepared to take a position. Yep. And following on from that, if you're wrong, you've got to accept that you're wrong and try and work out why you were wrong. On the flip side, you don't actually enjoy your successes either, because if you get something right, you've got to be very aware as to why you got it right and not display hubris. I think hubris is an absolute killer in investment management.
Very important in today's environment where things are changing so quickly. You can be right one minute and then be wrong the next, so you can't get too carried away.
That's right.
You?
Well, it's funny, within our portfolio management team, whenever we're wrong, we roll Leon out to do presentations. We're not seeing.
Fantastic. Bruce, thanks so much for sitting down with Livewire today.
Pleasure, Chris. Thank you.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content just like that every single week.